Welcome to the deep dive, where our goal is pretty simple.
Yeah,
Cut through the noise, the information chaos, and really hand you synthesized, actionable knowledge to stay ahead.
that's the plan.
And today, we are wading deep into crypto research. I mean, the market just generates noise faster than anyone can possibly process.
It really does.
And trying to find those genuinely overlooked opportunities, those, hidden gems, that's often what separates the informed investor from, well, the rest of the crowd.
It's a classic dilemma, isn't it? Due diligence is absolutely the foundation, the bedrock of successful investing.
Sure.
But in DeFi, honestly, it feels like a full-time job just tracking the data, reading all the docs, understanding the tech.
It's overwhelming.
It is. So our mission for you today is really focused. We're going to define in detail a safe, repeatable, structured, and maybe most importantly, an AI-accelerated workflow for finding these opportunities.
Okay.
We want to turn that information overload problem into more of a processing problem, something manageable.
AI accelerated. Okay, let's unpack this. Before we even bring in ChatGPT or the LLMs, we need to frame this, define the target. When we say hidden gem for this deep dive, what exactly are we hunting for?
Yeah, we need a really precise definition. Otherwise, we're just chasing random pumps or speculation.
Right.
So a hidden gem for this workflow, it's got to be a small cap or maybe a mid cap token, definitely far away from the big top 10 assets.
Okay, smaller coins.
Smaller, yes. And crucially, it must have specific, verifiable, positive attributes. We're looking for clear evidence, things like improving fundamentals, real early traction, or maybe overlooked catalysts, technical or market ones.
Things you can actually measure.
Exactly,
Yeah.
verifiable. And just as important, it still needs to lack that high mainstream coverage. If Bloomberg or, CNBC are talking about it daily,
Too late.
yeah, it's probably too late for the kind of edge we're looking for. The lack of hype is almost as important as the strength of the fundamentals here.
So we're not just looking for cheap tokens. That's not the goal. We're looking for fundamentally sound projects that the market hasn't fully priced in yet, probably because of lack of awareness or maybe just the info's hard to get.
Exactly that. We are hunting for alpha that genuinely requires research effort. It's not just sitting there on the surface.
Right.
And that brings us neatly to the AI connection. Why involve a tool like ChatGPT or any large language model when crypto research really relies on real-time, on-chain metrics?
Oh.
Isn't there a conflict?
Yeah, that's the challenge, isn't it? The data, the on-chain stuff is real time, but the documentation, the white papers, the audits, the tokenomics docs, they're static and often, frankly, massive.
And that's precisely where the LLM's main value lies. It's time compression, specifically time compression in digesting complex text.
Okay.
Think about the hundreds of hours potentially saved by not having to manually scan a 50-page white paper just to find the vesting schedule, or trying to compare governance mechanisms across 3 competing protocols by hand. The AI can summarize those complex docs, it can distill key risks, generate research checklists based on the documentation, and do rapid cross-project comparisons on criteria you define.
So the AI is basically handling the grunt work, the reading, the comparing, allowing the human, the researcher, to focus purely on the analysis and the decision-making part.
Precisely. It's an acceleration tool for your cognitive load. However, and this is absolutely the foundational caveat for this entire deep dive.
Okay, important point coming up.
Yes. AI must be paired directly with verified real data sources. If you skip the specialized data tools, the Masaris, the Dunes, and just ask the LLM for the current market cap or active users,
What happens?
you risk relying on outdated training data, or worse, what we call hallucinated facts. Things it just makes up because it doesn't have the live info.
Ah, right, fabricated information.
Exactly. The LLM is only useful for synthesis when the inputs, the numbers, the links, the metrics are collected from external, verified, often real-time sources like Masari, Dune Analytics, Nansen, etc.
Okay, let's get into that AI edge versus its limitations then. Where does it really provide a genuine, measurable advantage?
Well, if we isolate it, the edge is strictly within the processing, the structuring, and the synthesis stage. It absolutely cannot collect the primary data, but boy, can it organize complexity.
Right.
So the best fits for LLM acceleration are things like, as we said, deep document digestion.
And can you give some more specific examples? It's not just white papers you'd feed it, right?
Oh, absolutely not. Think about security audits. A typical smart contract audit report, it might be dozens of pages long, full of technical jargon, dense findings.
Yeah, tough reads.
Very tough. You can feed that raw text to the LM and ask it specifically, like ignoring the low severity stuff, list the 3 highest risk potential vulnerabilities you found in this audit. Boom, instant summary.
That's useful.
Or think about the complex legal structure some protocols have. The AI can help generate checklists to make sure you've covered all the compliance or regulatory risks mentioned in their legal docs.
And what about that explain like I'm 5 function? I
Mhm.
find that super helpful when I'm trying to wrap my head around some new complex technical thing.
It's incredibly valuable because it tests your own understanding, right? If you can't explain something simply, you probably don't understand it well enough to put money into it.
Good point.
The AI can take a really detailed explanation of, I don't know, a novel sharding architecture or some complex zero-knowledge proof implementation and break it down into simple bullet points or analogies. That acceleration of clarity, it's often the difference between grasping a core tech advantage and just dismissing a project as too complicated.
Yeah, I can see that. But let's be, brutally honest about the limitations too. This is the not a fit alone warning. Where do people commonly misuse these LLMs in crypto research?
Okay. The most common and honestly the most dangerous misuse is expecting real-time data or market-sensitive insights directly from the LLM.
Like asking for the current price.
Exactly. ChatGPT cannot give you real-time prices. It cannot give you privileged data on wallet flows unless you feed it the output from a tool like Nansen first.
Because its training data is old.
By necessity, yes, it's delayed, which means it absolutely must be used after the data is collected from those specialized real-time tools, the Masari screeners, the Dune dashboards, the Nansen labeled data. These are non-negotiable prerequisites.
Right.
Relying only on the LLM during the data gathering phase, it's like trying to navigate a fighter jet using a map printed 6 months ago.
You're going to crash.
You guarantee you'll crash into outdated or, worse, completely fabricated information.
That makes the relationship really clear then. The AI speeds up the thinking, the analysis, the organization, but it doesn't replace the initial verifiable data gathering. It's like a world-class assistant for the researcher.
Perfect analogy.
It takes the verified inputs you give it and structures them, but it's not the detective out there collecting the evidence in the first place.
Precisely. If we use, say, a legal investigation analogy, the LLM is the expert paralegal. Organizes evidence, cross-references documents, drafts arguments.
Okay.
But the dedicated data tools Dune, Nansen, Masari, they're the detectives collecting the fingerprints, the surveillance footage, in real time. You absolutely must trust the detective work before you ask the paralegal to synthesize the case.
Okay, this clear division of labor brings us right to the core of this deep dive, the repeatable, structured 5-step process. This is the roadmap, the workflow, designed to efficiently move you from that raw, overwhelming data to a concise, risk-defined investment thesis. Let's start with the first 3 steps, purely data gathering and shortlisting.
Right.
Step 1, source discovery. Let's call it the screening filter. The goal here is just managing that info overload. Create a short list, maybe 10 to 20 tokens max, that fit our hidden gem profile. Small or mid-cap, low coverage, high potential.
Exactly. And the action here is starting with neutral, specialized data hubs. Screeners, basically. Like the ones Masari provides are a good starting point. You're applying filters to quickly weed out projects that are either too large, no alpha left, or maybe too small, too illiquid, too risky.
You can be surgical with those filters.
Absolutely.
What are the specific, non-negotiable filters we should be using here?
Okay, first, you need to define your sector. Don't try to boil the ocean. Focus on narratives the market is maybe just starting to track. Things like L2 infrastructure, or deepen and decentralized physical infrastructure, or RWA, real-world assets. These are pretty focused areas right now. But commit to 1 or 2 for a screening session.
Focus is key. Okay, what else?
Second, valuation check. Critically important. You must filter using both market cap, MC, and fully diluted valuation, FD.
Why both?
Because for small caps, FDV is often the much better metric. It accounts for all those future token unlocks, the potential dilution down the road. If the FDV is astronomical compared to the current market cap, even if the MC looks small.
Danger sign.
Huge danger sign. The long-term sell pressure is likely toxic. We want projects where the FDV isn't, say, 50 times the MC, unless the tokenomics clearly show how value is captured proportionally to that dilution.
That FDV check is so critical. So many people just see the small market cap and completely miss the massive dilution bomb waiting to go off.
Yeah.
Okay, sector, valuation,
Yeah.
what else?
Liquidity checks. Non-negotiable. Can you actually buy or sell a meaningful amount without tanking or pumping the price? Use the screener's liquidity metrics or check the order books on major exchanges. If you can't get in or out reasonably,
You're trapped.
they're trapped.
Yeah.
And finally, developer activity. We need proof that the project is actually being built, actively improved. Look at platforms like Token Terminal or sometimes GitHub directly or other code tracking sites. Check the frequency of code commits, the number of active core contributors over the last, say, 90 days.
So not just hype, but actual work being done.
Exactly. If dev activity is flatlining, the project is likely dying, regardless of what Twitter says. High, consistent dev activity is a strong proxy for future potential.
Okay, great. So step 1 gives us a filtered shortlist. Active devs, sensible valuation, small cap projects. Now, we need to prove they're actually being used, not just held by speculators hoping for a pump. That takes us to step 2, on-chain validation.
Right. This is where we shift gears from market-level data down to granular usage data. And for this, powerful dashboards like those on Dune Analytics are indispensable. The goal is to cut through the hype, validate the project's actual utility. Is this token actually needed for the network to function? Is the fee revenue growing? Is anyone actually using this thing?
Makes sense. Which specific panels or metrics on Dune should we be prioritizing? Where do we focus?
You need to pull usage and holder data and critically track the trends, not just a single snapshot in time.
Okay, trends over time.
Yes. The key metrics to pull, maybe save links to the charts for, are active addresses daily or weekly, depending on the project's lifecycle. Transaction count shows the actual network activity load, new wallets created. This can be a measure of expansion velocity and new user growth. And potentially exchange flows are tokens moving onto exchanges to be sold or off exchanges into wallets for holding.
Why do these specific metrics, active addresses, transaction count, new wallets, matter so much more than just looking at the price chart?
Because they represent the verifiable difference between a temporary fad and an actual business being built. Think of it like this.
Okay.
Imagine a new app or an L2 or a game. If its token price is pumping like crazy, but the number of daily active addresses is totally flat. It's like a trendy new coffee shop where everyone's outside taking Instagram photos of the sign.
But nobody's actually buying coffee.
Exactly. The price, the hype is high, but the daily active transactions, the coffee purchases, are low. It's likely a purely speculative play, a fad, not sustainable.
But conversely, if the price is maybe flat or even drifting down a bit, yet active addresses are consistently climbing week after week.
That's the signal. That's fundamental adoption. That's a potentially healthy business being built under the radar. It's latent growth, just waiting for a narrative spark or wider market recognition.
Okay, and you mentioned tracking this over time.
Absolutely paramount. These metrics must be tracked over a sustained period. We think 4 to 12 weeks is a reasonable minimum baseline for this kind of analysis.
Right.
And you need to overlay notable news dates right onto those charts. If active addresses suddenly spike for 3 days right after a big partnership announcement.
Probably temporary hype.
Exactly. But if they rise consistently, steadily across 2 months, regardless of specific news events, that's a fundamental trend you can potentially build a thesis on. The long-term trend data is what separates durable utility from fleeting speculation.
Okay, fantastic. We've filtered the universe, step 1. We've proven the project is active and being used, step 2. But for real conviction, especially in crypto, we often want to know what the biggest, smartest players are doing. That brings us to the final data gathering step. Step 3, the smart money sanity check.
Yes. The goal here is straightforward. Verify accumulation or distribution patterns by players who are generally considered sophisticated. They might have better research, deeper network access, maybe earlier information.
And how do we do that?
For this, we rely heavily on specialized wallet labeling tools. Nansen is the best known example here. We're specifically looking to see if wallets labeled as sophisticated entities, think institutional funds, known market makers, prominent ecosystem investors or builders, have been consistently accumulating the token, or if they've been selling off, exiting their positions.
Okay, but I need to push back here a little. Isn't there an inherent bias? If we're waiting for Nansen to label wallets and then identify sustained accumulation, haven't we already missed the earliest cheapest entry point?
Mhm.
Aren't we just following the leaders after they've already made their move?
That is a really critical question. And the answer is nuanced. Yes, you will almost certainly miss the very earliest ground floor entry point that's often reserved for VCs or seed investors who got in months or years before the token even exists publicly.
Right.
Our target here isn't necessarily being the absolute earliest investor. Our target is the investor who gets in before broad market coverage starts, before the hype cycle really kicks in.
Okay.
Seeing smart money accumulation does two crucial things for us at this stage. One, their likely deeper due diligence serves as a confirmation signal for the positive fundamentals you spotted in step 2. It validates your own work.
Right. A sanity check.
Exactly. And 2, their presence, their buying, often helps stabilize liquidity and implicitly validates the longer-term investment case. It adds a layer of institutional credibility, if you will.
So we're essentially trading a potential for the absolute first 10x gain for maybe a higher probability of a safer 5x gain. It's a risk management trade-off.
That's a perfect way to put it. It's about increasing conviction and reducing risk by confirming your thesis with the actions of sophisticated players. But another big but.
Okay.
You have to be highly critical when interpreting Nansen data or any wallet tracking data. Don't just look at a single massive inflow transaction,
Why not?
because that could be anything. A fund rebalancing between wallets, a treasury transfer for operations, a large over-the-counter OTC deal that doesn't reflect market sentiment. It's noisy.
So what should we focus on?
You need to focus on sustained, repeat buys from multiple labeled wallets over that same 4-12-week period we discussed. Look for the pattern, not the single snapshot. Are several known funds or market makers consistently adding to their positions week after week?
That shows real belief.
It shows sustained belief in the project's long-term value, not just a reaction to some short-term hype. This consistent accumulation pattern acts as our final filter before we unleash the AI for synthesis.
All right, this is the turning point. We've done the hard yards gathering verifiable data, the screening, step 1, the usage validation, step 2, the smart money check, step 3. Now we transition to analysis and synthesis. This is where the AI, like ChatGPT, really starts to shine, structuring and stress testing all that raw data we collected.
Exactly. We're moving into step 4, ChatGPT synthesis. And this is where the magic can happen, but only because we put in the work to gather high-quality ingredients first. Garbage in, garbage out, especially with AI.
Right.
So the action here is feeding the LLM your actual verified findings. You literally paste in the key quantitative metrics, active addresses up 35% over the last 6 weeks. You give the links to the specific Dune dashboards you used. You paste critical excerpts from the tokenomics documents you found on Masari or the project site.
This is that crucial distinction again. We are not asking the LLM to go find data in the wild. We are asking it to process and structure the verified data we meticulously collected in steps 1 to 3.
Precisely. We are leveraging its incredible organizational and language processing capabilities, not its often flawed world knowledge base.
Okay, so we feed it the good stuff. What do we ask it to do?
Then you issue a comprehensive prompt. You ask the LLM to synthesize all this disparate data to generate 4 specific mandatory outputs. These are designed to accelerate your own due diligence process significantly.
4 outputs. What are they?
First, ask for a synthesized, prioritized list of risks associated with the project. These risks should be derived directly from the documentation you fed it, like tokenomics flaws, audit findings, and potentially implied by the on-chain metrics, like maybe slowing user growth despite price action.
Okay, risk list first. Makes sense.
Second, a detailed competitor map and comparison table. You instruct it. Based on the technical docs and market positioning I provided, create a feature-by-feature comparison table against its main competitors. This forces the AI to structure the competitive landscape, giving you instant context on relative strengths and weaknesses.
Super useful for positioning. Third,
a moat analysis. Ask it. Based on the tech docs and market data, what makes this project truly unique, defensible, or difficult for a well-funded competitor to replicate quickly? Is it network effects, unique tech, community, what?
identifying the sustainable advantage. And the fourth one.
And fourth, this one is critically important. Falsification tests. Ask the AI, given my bull case thesis, which you state clearly, define clear metric-based tests that would definitively invalidate this bull case.
Falsification test. Let's pause on that.
Yeah.
That sounds like structured intellectual humility, forcing yourself to define how you could be wrong. Can you give a concrete example? Like, what would the prompt and the output look like?
Sure. Let's say you're analyzing a new Layer 2 solution. Your bull case hypothesis might be something like, I believe Project X will capture 10% market share of unique daily L2 users within 12 months because its novel execution environment offers 50% lower gas fees than competitors A and B.
Okay, clear hypothesis.
You feed the AI this hypothesis, along with the competitor data from the table it generated, the user growth trends, etc., and you ask for falsification tests. The AI might come back with something like, falsification tests, #1. If Project X's total value locked, TVL growth stalls or declines for more than 45 consecutive days, while its main competitors, A and B, collectively capture more than 50% of all new unique daily senders across the L2 sector during that same period, the bull case based on fee advantage capturing market share is likely invalidated.
Wow, okay. That is really specific and actionable. It takes the decision-making away from just vague feelings or hope and ties it directly to measurable, observable metrics. It tells you exactly when you need to admit you might be wrong.
Which is often the hardest but most important thing for any investor to do. And that structure, that predefined I'm wrong if X happens, leads us perfectly into the final step of the workflow. Step 5. Risk controls and pre-mortem. This is where we solidify the thesis with proactive defense and psychological preparation.
Right, this sounds like integrating behavioral finance directly into the analysis process, using the AI for that.
Exactly right. You use the LLM here almost purely as a structured thinking partner, a sounding board. You task it based on the risks it identified for you in step 4 to help you draft specific position sizing rules. For example, given the high unlock risk in month 6, limit initial position to 1% of portfolio.
Okay.
You use it to help define specific non-emotional exit criteria, maybe based on those falsification tests. I will exit the position entirely if active addresses fall below 80% of their 90-day peak and stay there for 2 consecutive weeks. Write it down, commit to it.
And the pre-mortem exercise, that sounds powerful, but also maybe a bit counterintuitive.
Yeah.
How do we ensure that running a pre-mortem, imagining failure, doesn't just subconsciously anchor us to that failure scenario and make us too scared to actually make the investment?
That's a really profound point, actually. The framing is key. The premortem must be framed as a forensic exercise, not as some kind of self-fulfilling prophecy.
Okay, forensic exercise. How?
The prompt shouldn't be, will this fail? It should be something like, assume this investment has definitively failed 6 months from now. Based on the risks we identified in step 4, tokenomics, competition, adoption, walk me through the most plausible sequence of events, the narrative that led to that failure.
Ah, okay. Working backwards from assumed failure.
Exactly. By generating this logical failure narrative before you invest, you achieve a couple of things. You directly combat confirmation bias, that very human tendency to only seek out data that supports your decision after you've made it.
Right, we all do that.
We do. And when you're forced to logically construct how failure could happen using the risks you already identified, you're sort of psychologically inoculating yourself against the emotional pain of loss if it does happen. You've already lived it mentally. It helps prevent clinging to a losing trade based on hope.
That is really powerful psychological risk management. Confronting and structuring the failure scenario before committing capital makes you prepared for both outcomes.
So to get this high-quality analysis reliably out of the AI, you can't just ask simple questions. You need slightly more sophisticated prompts. We've found 3 specific prompt engineering techniques or patterns that consistently yield more structured, actionable analysis.
Okay, give us the patterns. How do we elevate the quality of the L1 output from basic summary to real analysis?
Okay, first is the summarizer pattern, but with a twist. We use this for document digestion, but add a critical edge. The prompt looks something like this. Summarize this project's tokenomics, its emissions schedule, and particularly the unlock risks, using these pasted documents or links provide them. Then, based specifically on the potential supply shock from unlocks and the vesting periods you found, list 5 specific red flags or events that could cause a major price drawdown.
Ah, so it's not just summarizing what is it. It's summarize and then use that information to immediately identify potential problems related to supply.
Exactly. It forces the LLM to move from passive digestion to active critical analysis focused on a key risk area, supply shocks. It turns a huge block of text into a prioritized, bulleted warning system. Very efficient.
Yeah, that's efficiency right there, going from what is it straight to what are the biggest landmines related to supply. Okay, pattern number 2.
Second, we call it the comparator pattern. This is fantastic for getting quick context on unit economics and the competitive landscape. The prompt needs to be highly structured. Something like, create a detailed feature-by-feature table comparing Project A, our target, versus its main competitors, Project B and Project C. include columns for consensus mechanism, core fee model, estimated treasury runway in months, top holder concentration percentage, and stated roadmap maturity for Q4. Use only the pasted notes and official links I am providing now.
Okay, very specific columns and restricting it to the provided info.
Yes, that prevents hallucination. This instantly visualizes the competitive field. It helps you understand relative value without spending hours manually building a comparison spreadsheet yourself. If Project A has maybe a 3-year treasury runway based on its docs, but competitor Project B only has 6 months left.
That's a huge comparative insight right there.
Instantly surfaced. Super valuable for relative assessment.
Definitely superior to manual spreadsheet building for every single competitor. Okay, and the third and final pattern.
This one we call the signal-to-noise pattern, or maybe the devil's advocate pattern. It's specifically designed to stress test your own inherent human bias towards the project you've just spent hours researching.
Fighting confirmation bias again. How does this one work?
The prompt goes something like this. Okay, here are the key on-chain metrics I've verified, e.g., active addresses up 20% month over month, but unique senders are flat. And here are the Nansen wallet label observations, e.g., smart money accumulation is minimal, mostly retail buying. Now, based only on this data, argue against investing in this project right now. Specifically, what negative narrative or interpretation would invalidate the apparent bull case, even if the price is currently rising?
Wow. Okay, so you're explicitly telling the AI to build the bear case using the data you found, even if some of it looks positive on the surface.
Precisely. It forces the AI and, more importantly, forces you to rigorously challenge your own bias, to give significant weight to any contradictory evidence or alternative interpretations. It ensures you're not just seeing what you want to see.
Okay, these patterns are great. Let's try to bring this entire 5-step workflow, including the AI synthesis, to life. Can we walk through 2 hypothetical case studies? Maybe one success and one near miss, where the process saves someone from a bad investment.
Absolutely. These kinds of stress tests really show the workflow in action.
All right, case study 1. Let's call it Smart Money Confirms the Thesis. This is our hypothetical success story. We start at step 1, the Masari screener. It flags, let's say, a layer 2 focused on data infrastructure. Ticks the boxes. Low, fully diluted valuation relative to the actual fees it's generating, and crucially, it seems to be flying completely under the radar, barely any mentions on social media, low analyst coverage.
Okay, good candidate. We move to step 2, on-chain validation. We pull up the relevant Dune dashboards, and the data is compelling. We see a consistent, undeniable upward trend. Daily active users and the total fees generated by the protocol have been rising steadily week over week for maybe 9 consecutive weeks.
9 weeks straight.
Yeah, a genuine, sustained sign of adoption. It strongly suggests the product market fit is real, not just temporary hype. People are actually using it and paying for it.
Okay, strong fundamental signal. Now for step 3, the Nansen confirmation. Does smart money agree?
And let's say in this case, step 3 seals the deal. We check the Nansen wallet labels for this token, and we find evidence of repeat, maybe small but sustained accumulation buys, specifically from, say, 5 different named sophisticated venture funds or market makers happening over that same 9-week period.
So not just one big whale buy, but coordinated, consistent accumulation from known smart players.
Exactly. That pattern provides significant validation. So now we move to the AI synthesis, steps 4 and 5.
Right.
You feed ChatGPT the links to the Dune dashboards showing the rising usage, the summary of the Nansen findings about fund accumulation, and excerpts from the tokenomics explaining the fee capture. The AI takes these inputs.
And what does it output?
It synthesizes them into a concise, easily digestible investment thesis, maybe highlighting the synergy between the growing user base and the validated smart money accumulation. But crucially, using maybe the summarizer pattern on the tokenomics docs, the AI also spits out a clear, prioritized risk list. Perhaps it flags a complex vesting schedule with a moderate unlock coming in 4 months.
Okay.
This allows the investor to size their position appropriately, acknowledging that specific risk alongside the clear growth signals. The whole process, which might have taken weeks of manual digging and analysis, gets compressed potentially into a single focused afternoon using this workflow.
That's the dream scenario. Efficiency plus conviction. Now let's flip it. Case study 2, the near miss. This is how the workflow saves you capital, helps you identify and consciously avoid a potential trap. Let's say we find a token that's generating absolutely massive sustained hype on social media. Twitter's buzzing, influencers are shilling it, the price chart looks like a rocket ship, the FOMO is intense.
Yes, the classic hype cycle. Okay, but we stick religiously to the workflow, no exceptions. We move to step 2, the on-chain validation check. And, We find a stark contradiction between the social narrative and the actual usage reality.
What does Dune show?
Dune Analytics shows maybe flat or even slightly declining active addresses over the past month, and perhaps more worryingly, a sharp drop in the number of unique senders. Fewer distinct wallets are actually interacting with the protocol.
So lots of talk, but usage is stagnant or falling. Big disconnect.
Huge disconnect. People are talking, but they aren't actually using the product. Then we check step 3. Nansen, what's the smart money doing amidst this hype? And Nansen confirms the worrying usage trend. It shows clear net outflows from wallets labeled as smart money over the past month. They're selling into the hype, not buying.
Wow, so the verifiable data completely contradicts the social media narrative. The noise is deafening, but the actual signal is flashing bright red. How does the AI help us navigate this in the risk phase, steps 4 and 5?
Okay, the user, seeing these conflicting signals, hype versus reality, retail FOMO versus smart money selling, decides to run a heavy risk mitigation step using the AI. They specifically ask ChatGPT, step 5, to help draft a pre-mortem analysis.
Okay.
And as input for this pre-mortem, they feed the AI the token's detailed vesting schedule and supply information, which, let's say, was incredibly complex and buried deep in some governance forum post, not easily visible.
Hidden complexity.
Exactly. The AI, perhaps using that summarizer pattern we discussed, digests this complex supply info and immediately spots a major issue: a huge, previously unnoticed emissions overhang. A massive multi-million-dollar chunk of tokens is scheduled to unlock and hit the market next month.
The unlock bomb.
The unlock bomb, completely obscured by all the social media hype. The AI then helps outline the highly probable failure scenario. The token price likely tanks hard upon this massive unlock, regardless of fundamentals, which were already questionable based on usage data.
And the result?
The result is clear. The user, armed with this structured analysis of the usage data, smart money flows, and the hidden supply risk surfaced by the AI, confidently passes on the investment. They avoid a potentially massive drawdown triggered by that mechanical supply shock that the hype mob completely missed.
That right there is the ultimate value proposition, isn't it? The workflow, amplified by the AI, didn't just tell you what to buy, it accelerated and structured your decision to not buy, which, let's be honest, is often the most profitable decision an investor can make in crypto. Saving capital is key.
Absolutely. And to execute this kind of advanced AI-assisted strategy successfully week after week, you need to be really surgical and rigorous about the specific metrics you track consistently. We rely on what we call 3 mandatory data panels. These move way beyond just simple price and volume.
Okay, let's break down these panels. Panel 1, the on-chain traction panel. This is about proving real utility, right?
Correct. Here we prioritize those 3 key metrics we discussed: active addresses, transaction count, and unique senders. These are the vital signs of a protocol's health. If 1 million addresses hold a token, but only a few hundred are actually active daily.
It's mostly dormant holders, not users.
Exactly. You've achieved distribution success, maybe, but not utility success. And again, we track this data over 12 weeks minimum. Daily volatility in these metrics is mostly noise. The sustained, multi-week trend is the signal we care about.
Any more advanced metrics within this panel?
Yeah, for a more sophisticated look, especially within Layer 2 ecosystems, you might dig deeper than just total transaction volume. Look at the distribution of gas usage among the different protocols built on that L2. Is your target project consistently driving a significant, maybe growing percentage of the total gas consumed on the network?
So is it becoming indispensable to the ecosystem?
Precisely. That suggests deep integration and real demand, not just transient speculative traffic hopping between dApps.
Okay, great. Panel 2.
Panel 2, holder quality and concentration. This is where the Nansen layer, or similar analytics, comes in heavily. It's about analyzing who owns the supply and, critically, where it's moving.
What are we tracking here?
First, track the top 10 or top 20 holder percentage over time. If just a handful of early whales or the team wallet dominate the liquid supply.
Big red flag. Centralization risk.
Huge red flag. Centralization risk, potential exit liquidity issues down the line. But more specifically, we track the number of distinct wallets labeled as fund market maker or smart money that are net accumulating versus those that are net distributing each week or month.
Tracking the count of smart wallets accumulating, not just the total volume.
Yes, because it shows the breadth of conviction. Is it just one fund buying, or are multiple sophisticated players seeing the same opportunity? This allows us to construct something really powerful we call the smart money heat map.
Smart money heat map. Tell me more. That sounds advanced.
It is. We track these weekly net flows from labeled smart money wallets, but we segment them by protocol sector: L2s, DEMPIN, RWA, gaming, DeFi lending, etc.
Why track fund flows by sector? What does that tell us?
It helps you spot potential sector rotations early, often before the narrative hits mainstream crypto media or influencers. For instance, if you consistently see net outflows from wallets labeled as active in DeFi lending protocols for several weeks, but at the same time, you see sustained net inflows into wallets known to be active in DePIN and RWA projects.
That suggests the big money is repositioning, shifting focus.
Exactly. It suggests where sophisticated capital believes the next major growth narrative might emerge. This gives you valuable lead time, helping you prioritize opportunities from your step one screened list that align with these nascent institutional flows.
That's a really powerful edge. Okay, panel 3.
Panel 3. A mission and unlock calendar. This is all about the unit economics of supply. Understanding dilution is non-negotiable if you want to avoid being blindsided.
Where do we get this data reliably?
This is primarily derived from meticulous reading of official tokenomics documents, governance forums, and often aggregated by data providers like Messari. You need to map out the cumulative circulating supply versus the fully diluted valuation, FDV, at key future dates.
Mapping out future supply.
Yes, and specifically, you must calculate the expected sell pressure from major upcoming scheduled unlocks. For example, if your analysis reveals that, say, 50% of the total remaining unvested token supply unlocks for early investors in the team over the next 4 months.
You need to quantify that.
You need to quantify the approximate USD value of that unlock at current prices to understand the sheer scale of the potential mechanical sell pressure hitting the market. The AI can help process the complex, unlock scheduled details from the docs, but the human researcher has to decide if the fundamental growth story, from step 2, is plausibly strong enough to absorb that incoming supply without cratering the price.
Right. Growth versus supply pressure. It's a balancing act.
Yeah.
Now, this whole workflow is designed to find hidden gems, which often means smaller market caps, potentially lower liquidity. We absolutely must talk about the safety checks and ethical considerations here.
Couldn't agree more. The final safety requirements are paramount, especially in this segment of the market. First, you must be hyper alert for potential pump and dump dynamics. These thrive in low liquidity environments. A quick check. Can a relatively small investment, small relative to your typical position size, significantly move the price of the token on the main exchanges?
If yes.
If yes, that signals a thin liquidity environment. It's a major risk. Your investment itself could be potentially illiquid when you need to exit. Proceed with extreme caution, or more likely, just pass.
Makes sense. And what about that concentration rule you mentioned, derived from panel 2 data?
Yes, the holder concentration. If your analysis using Nansen or similar tools reveals that the top, say, 10 non-exchange, non-protocol wallets control a significant, overwhelming percentage of the liquid supply, the definition of significant depends on your risk tolerance. But generally, anything above 50% concentrated in so few hands is highly dangerous.
What's the verdict?
It's a clear, unambiguous risk indicator. The potential for manipulation, for coordinated dumping, or just massive sell pressure if one whale exits is simply too high. Our definitive recommendation, based on analyzing countless past failures, is usually just to pass on that opportunity. Find something with healthier distribution. And the final guiding principle here, the mantra that must be followed religiously throughout this entire process. Use AI to explain risk, never ever to ignore it. The LLM should make you more cautious, more structured, more aware of potential downsides, not less disciplined or more prone to FOMO. So, just to recap our journey today, the real transformative power of AI in crypto research, as we see it, isn't really in primary data collection. It's purely in the synthesis, the structured analysis, and maybe most uniquely, in facilitating that psychological risk management piece.
Right.
It takes that complex, verified data you feed it and helps rapidly construct a clear, defensible thesis and, just as importantly, a clear risk profile. But the power of the overall workflow itself lies in its disciplined structure, combining the high-level screening from tools like Messari with the granular usage proof from Dune and that critical smart money validation from Nansen.
They work together.
They have to work together. Without those verifiable data inputs feeding the machine, the AI is, at best, a sophisticated distraction, and at worst, a dangerous source of confident-sounding misinformation.
The key takeaway, then, is really understanding that these tools, the data platforms, and the AI are separate, but they're critically interdependent. You need the whole chain. When used correctly together, they form a pretty robust shield against market noise, hype, and purely emotional trading decisions.
Well said.
So, as we wrap up, we want to leave you with a provocative thought, something to mull over, forcing you to choose signal over noise in your own process. Imagine this scenario. Nansen's labeled smart money wallets are clearly actively exiting a token you're watching. Net outflows week after week. But at the same time, social media sentiment is absolutely mooning. It's pure rocket emojis to the moon posts fueled by hype and FOMO. Which signal do you follow? The verifiable flow of sophisticated capital hitting for the exits, or the deafening roar of the crowd narrative? That's the kind of hard question this structured workflow forces you to confront and hopefully answer rationally, long before you click buy.
That's the test.
We really hope this deep dive into AI-assisted crypto research has been valuable, maybe giving you a concrete framework or refining your own process. If this workflow helped you define your search criteria better, or gave you specific metrics to start tracking, or maybe just clarified how to actually use these powerful tools like ChatGPT, Nansen, and Dune together,
Yeah.
well, we need your help too.
Yeah, absolutely.
Engaging with this deep dive.
Yeah.
Subscribing to the channel if you haven't already, dropping a comment below, maybe letting us know which metric you think is the absolute must-have before buying, or just hitting that like button. It genuinely helps support us.
It really does.
It boosts our visibility in the algorithms, lets YouTube know you value this kind of content, and frankly, it allows us to keep creating this sort of quality, research-heavy crypto analysis for you. We love doing it, but your engagement makes it possible.
We appreciate it.
So thanks for diving deep with us today. We'll catch you on the next one.